What causes early assignment for into-money covered calls? Imagine you own a stock and sell a call option on it. You might think you can hold that position until the option expires, but sometimes it gets assigned early. So, what makes that happen? Well, when the stock price rises above the strike price of your call option, the holder has a reason to exercise it sooner rather than later. They want to buy the stock at the strike price, which is lower than the current market value, and lock in a profit immediately. The deeper into money the option is, the more tempting it is for the holder to exercise early to realize that gain. Another big reason for early assignment is dividends. If the stock is about to pay a dividend, the option holder might choose to exercise early to own the stock and qualify for that dividend payment. Since call options do not pay dividends, exercising before the ex-dividend date makes sense for them. This is especially common when the dividend is significant compared to the remaining time value of the option. As the expiration date gets closer, the time value of the option decreases. When there's little time left, most of the option's value is intrinsic, meaning the difference between the stock price and the strike price. Because of this, holders often exercise early to lock in that intrinsic value. They want to avoid the risk of the stock price dropping before expiration. Most stock options in the United States are American-style options. This means the holder can exercise at any time before the expiration date. This flexibility makes early exercise possible and sometimes likely, especially when the reasons we just discussed come into play. It's also important to remember that the Options Clearing Corporation randomly assigns exercise notices to sellers of the same call options. So, even if you don't expect it, you could be assigned early. Corporate events like mergers, takeovers, or special dividends can also trigger early exercise. These events can change the value of the stock or the rights associated with it, prompting the holder to exercise early to maximize benefits. For someone selling covered calls, early assignment means you have to deliver your shares at the strike price sooner than expected. This can limit your upside profit but also guarantees the strike price plus the premium you received. To manage this risk, it's smart to keep an eye on dividend dates, stock price movements, and corporate actions. Sometimes, closing or rolling your position can help avoid unexpected early assignments. In short, early assignment happens because the option holder wants to lock in profits, collect dividends, or respond to corporate changes. Understanding these triggers helps you prepare and manage your covered call positions better.